University of Delhi. And in both these sessions, the area broadly is same. That is investment behavior. Investment broadly it is on investment. And the third and fourth sessions will be handled by Professor Sangeeta Sahu from University of Lucknow. The last session will be handled by Professor Ambika Prasad Pati from Department of Commerce, NEHU. He is also Dean, the School of Economics, Management and Information Science in NEHU. Basically, he's a good researcher and he wanted to speak on good research, the academic imperative. Okay. So we tried our best to select the most eminent people in the field from all over the country. So please make use of their expertise. They are from North, they are from South, they are from Northeast. And yesterday I posted you some information regarding submission of seminar presentation. The number of words, just 3,000 to 3,500 words only. I don't want you to write so much. Write little, but with a lot of thinking. In your write-up, your originality should be reflected. Your original idea should be reflected. That is the idea. And please avoid writing from your already published publications or thesis, whatever it may be. Try to write afresh. The most contemporary topic of your interest, try to select. Try to give the latest statistics, and your write-up should be based on secondary data, secondary sources of information. And we look for your own view in the write-up. What is your view, finally, about the topic selected by you? That is what we will look for. Okay, so take it a challenge. And of course, as faculty members, it is our job to write also, not only to take classes, to write something meaningfully about the issues confronting the nation. Because when you write something in the form of a research article or in the form of a seminar paper, or even in the form of a newspaper article, right? It has some credibility because it is written by an academician with objective mindset. And people respect it. And people consider that we are the experts in the field. So we need to keep up their expectation, public's expectation. Okay. Dr. Lalrupi, she also joined. She asked, sir, do we have to write course report? That is not required. I think that is not required. Then But make a notes when you feel that, because our memory is very short, right? And we have to be like a good student always, right? Good teacher is always like a good student. And so whenever you feel like noting down some points, just to make a notebook for your own purpose, for your own things. Most welcome. Good morning, Kamaiah garu.
Good morning, sir. How are you?
Very fine, sir. Very fine. Yesterday I returned from Petlavad. I met your beloved student there. So sometimes the world is very small.
Yes, sir, with thanks to technology. So how long you are there, sir, in the university?
I joined here in 2004. This is my 18th year in Mizoram.
Oh, great.
Earlier, I worked in Chirala VRSN YRN College, Tragasam district. It was a big college, and I worked in postgraduate department of commerce there. So then in 2000, our university was established in 2000. So we were one of the founding faculty members in the university. And as you know, Central University attracted me to Mizoram.
I think it should be a good place.
Yes. Very, very pleasant and peaceful place. People are good, and now university is grown up well with more than 40 academic departments under 8 schools.
And you have a very dynamic vice chancellor.
Yes.
I met him in Hyderabad some time ago.
Okay.
In a marriage function.
I will convey.
Yes, sir. Please convey my regards to him.
To him, certainly, yeah. He's very dynamic, and he's also trying to make us more dynamic.
Yeah, he will not let others sleep. To be very brief.
Yes. It should be like that only.
Yes.
So he said this is a small group across the country. We have 40 faculty members from different colleges.
Okay.
And the faculty members belong to commerce, economics, and management.
Okay, sir.
This is our HRDC, UGC HRDC program, a 2-week refresher program.
So very nice, sir. And I can go up to 11:30, isn't it?
Up to 11:30. Actually, our HRDC is not allowing the participants to speak up, but they can record. They can post their questions in the question and answer or chat box. And
maybe, sir, if you permit, toward the end.
Yes.
Maybe 5-10 minutes time we can give for interaction.
Yes, sir. 10 minutes. Yes, certainly.
Yeah, that time I think we can talk to people directly.
Yes.
They can ask questions and.
Yes.
That will be fine.
You are in Hyderabad, sir, now?
Yes, sir.
Nice.
I'm now with the School of Management Studies. So my term is there till this month end.
Okay.
So things are fine, and I was associated with this school thanks to Professor Apparao garu when he was Vice Chancellor.
Okay, nice.
Earlier I was in Department of Economics.
Yes, sir.
For a long time.
Yes, sir. Because it's difficult for the university also to, to leave people like you, even after superannuation.
They wanted, and I was also in Anantapur Central University as the first dean in charge of the university. That time, Professor Apparao as Vice Chancellor, he deputed me there. So until COVID, I was there. In COVID, there were restrictions thanks to lockdown and all. Then I got back to the university. So that was the background. And basically, I teach financial economics econometrics, time series and spectral methods, macroeconomics, etc. Financial econometrics also I taught for quite a few batches. And now, getting into behavioral finance.
Okay.
The upcoming field.
Okay.
It's a totally a new dimension.
Yes.
For those who were molded in the traditional theory. So, but I find it very challenging and interesting. I thought I will give a lecture to your audience on this upcoming. Of course, some of you may be working in this area. I'm not ruling out that possibility.
Yes.
But a few others may not be familiar with this. I thought it could be a kind of a heuristic introduction to behavioral finance and how the traditional finance is restrictive in terms of assumptions, unrealistic assumptions, then how behavioral finance could possibly provide a solution to some of the financial issues or problems. That is the background.
Yes, sir.
So I would like to focus half the time on how traditional finance is wanting, how some of the assumptions are very restrictive. Then I will get into the behavioral finance, the biases, and some research areas also I would like to focus on. This is the broad plan of my lecture.
Nice, sir. Nice. Actually, speaking to you itself is education, sir. That is why. That is why this morning I posted in our participants group that be there on time because you are going to get a rare opportunity of interacting with an internationally acclaimed economist. Because good morning to all the participants. And today, really, we are fortunate to have Professor B. Kamaiah garu. And actually, I asked him to give his CV. Then I felt very bad because he did not give me his CD because if you type his name just in your free time, the simple suggestion to the participants, just type kamaiahbandi, kamaiahbandi, B-A-N-D-I. Then you get a lot of academic literature about him. So he did his BA in 1973 from SV University, Tirupati. Then he did his MA Economics in 1975 from Sri Venkateswara University, Tirupati. Then he did his MA Econometrics from the same university in 1978. Then he did his PhD in economics from Indian Institute of Technology, Bombay. Then he has been in academics for more than 40 years. And he was Dean in charge of Central University of Andhra Pradesh for some time. Then Dean R&D, Sri Mata Vaishno Devi University, Katra, Jammu for some time. Then he was head of the department, School of Economics, Sri Mata Vaishno Devi University. Then he was Dean, School of Economics, University of Hyderabad, and very long time he served in Hyderabad, and he superannuated from Hyderabad. And incidentally, again, he is serving Hyderabad University in a different capacity. So for people like him, retirement or superannuation is only a technicality. And then from 1998 to 2017, he was a professor in the Department of Economics, University of Hyderabad. And he was RBI chair professor and head RBI Endowment Unit, Institute for Social and Economic Change, Bangalore. Then he served Hyderabad Central University Department of Economics as head. And he was a visiting faculty, Indira Gandhi Institute for Development Research. Then he started his career in Pune, in National Institute of Bank Management. as faculty research associate from 1983 to 88. Then for some time, he also worked as associate professor in Indira Gandhi Institute of Development Research in Mumbai for 1 year in 1988 to 89. Then he has been holding so many, he holds so many, so many associated with so many organizations as a member, present and past, and he was a member, board of directors, Ministry of Defense in some committee, then member, board of governors, Management Development Institute, Gurgaon, president of the Indian Econometric Society, expert member, subcommittee for constructing service index for the insurance sector, DIPP, Ministry of Commerce, Government of India, expert member, committee for preparing manual for insurance statistics, IRDAI, Hyderabad, life member, Indian Econometric Society, UGC nominee for different committees, UGC expert member, member academic council of different universities, board of studies in different universities, member expert committee to review curriculum in economics and finance, BITS Pilani, member international steering committee for international conference on law and econometrics, so on. So without taking much time, there are still, there are very long biodata. He is on editorial boards for at least half a dozen journals and more than 150 publications in nationally and internationally reputed journals. Then, the number of PhDs produced by him, it is 50. He produced 50 PhDs and an equal number of MPhils, and he delivered many keynote addresses, chaired several technical sessions in conferences, acted as a resource person, and also served in several selection committees in various universities and institutions. So this is about his brief biodata, but whatever this biodata has not reflected, his beloved students, Professor Giribabu of Economics Department in our university, and I happened to meet one of the alumnus of Department of Economics, Hyderabad Central University, just a few days back in my field team visit in Madhya Pradesh, and he used to speak very much about him, and sometimes these CVs, they won't reflect certain human qualities of a person, and those things I could understand from his beloved students. And I don't want to stand in between you and the speaker. With this brief introduction, I welcome Professor B. Kamaiah garu. Sir, this is your time now, please.
Thank you, sir. Thank you very much. Am I audible? Hello?
Yes, sir. Yes, sir. Yes, sir.
Yeah.
They may not, their audio is switched off. Yes, sir. Yes, sir.
So thank you, Professor Jyoti Kumar garu. I'm really pleased to hear some good words from you. Thank you very much for inviting me to your university to address the refresher course participants. I feel good that, I'm with all of you today. So the topic that I would like to discuss is behavioral finance. So the behavioral finance is a very young discipline. It first started in 1970, and later on it was growing gradually, and of late it is somewhat rapidly. The behavioral finance is basically a sub-branch of behavioral economics. And behavioral finance came up as a subject which was challenging the traditional theory of finance, which was not an easy task because the traditional finance was so strong in terms of its foundations, its spread, its policy influence in so many dimensions. And many Nobel laureates have also worked in the traditional finance area and made it a very strong discipline. But behavioral economics started questioning the very foundations. So what are those foundations on which the behavioral finance stands, and what are those foundations in the traditional finance which were found wanting? What were those assumptions which were basically restrictive in nature? So these are the issues that we focus upon today. So before we go into those details, first let us take stock of what is traditional finance and what are the crucial assumptions on which it is based, and what are the limitations. Then we talk about how those limitations could be overcome. So for that, the starting point would be to understand investment. Investment traditionally is understood as a current commitment of resources in order to achieve later benefits. That is, present commitment of money for the purpose of receiving hopefully more money later. So that is a very simple and traditional way of looking at investment. Investment would also be interpreted as a flow, that is, flow of expenditure and receipts spanning over a period of time. So if investment is understood as a flow, then what should be the objective of investment? The objective should be to tailor the cash flow in a desired manner. That is a fair enough objective of this. So the investment process involves certain decisions. It could be at the personal level, which we call personal investment decisions. It could be at the level of a firm or a corporate, in which case we call them as business decisions. Even government decisions could also come within the purview of the decisions. Now, in between the investors and those who borrow from investors, there are markets. Markets mediate the transactions. So they are the financial markets. And the financial markets provide alternatives for investors. Okay. So in this context, we have to make note of three important things. One, decision making under uncertainty. Because investment, when it is done with a view to receive the future stream of returns, obviously there is an element of uncertainty. And what kind of uncertainty it is? It is associated with the state of the economy or environment or the world at large. The world at large. So that means decision-making under uncertainty becomes the most important issue. Then second is, in simple traditional finance, no arbitrage assumption has been invariably made. What is the meaning of no arbitrage assumption? It simply means that if there are two different securities with identical properties, they have approximately the same price. So that means there is no arbitrage. Arbitrage opportunities do not exist if the markets are efficient. Third is financial markets are dynamic in nature. That is, financial instruments are traded continuously. The future price of the asset is not a single number. It moves in time and subject to certain uncertainties. I'm repeating, how do we characterize the financial markets to be dynamic? First, financial instruments are traded continuously. When it is done, what about the future price of the asset? It's not a single number. Today, the return could be one number. Tomorrow, the return could be another number. Or today itself, the future return could have, depending on our expectations, depending upon how we perceive uncertainty, we have a sequence of numbers, each number associated with a probability. Maybe 3% return, the probability for that is say 0.5. 4% return, the probability is 0.4, like that. So the future price, therefore, of an asset is not a single number. It moves in time and subject to certain uncertainties. And those uncertainties we capture in terms of certain probabilities, okay? Now, the whole thing should take place according to a process. There exists, at least we assume that there exists a process which generates these probabilities. To simplify matters, if you invest in a stock, what you get over time is not very certain, okay? And different people view the returns with different probables, with different probabilities. So therefore, a better way would be to understand the process that is capable of generating alternative returns, okay? Now, the challenge here is, how do we characterize the process? In traditional finance, there are certain models. Some of you may already be familiar with these models. To mention a few, we have the binomial lattice models, models based on difference equations, models also based on differential equations in the case of the continuous investment horizon. So all these models, it is significant to note that they are based on past prices and other informations are also used in these models. But investment is dynamic. The value of investment changes with respect to time, and the composition of good portfolios may change. If you consider a portfolio to be good, it may not remain constant. That may change. So therefore, this dynamic character is to be first understood, then second, it should be formalized, okay? So first is how to capture the process, then how to understand and formalize this. So it is in this background, we also should introduce the notion of risk, which is important. Suppose there are two possible investments with the same expected return, okay? So the expected return is a probable, okay? So the return is certain, let us say for investment 1, and return is uncertain for investment 2. What should a rational investor prefer? Okay, he should prefer, if he is a risk averter, he should prefer the return 1, where investment is certain, okay? So therefore, if more risk is accepted, then the expected return should be higher. Now, in this context, it is of paramount importance to understand risk and also to formalize risk. Okay? So formalizing this in traditional finance, the mean variance analysis has been adopted. What is that mean variance analysis? If there are several investment opportunities, and if they have the same mean return, the expected return is assumed to be the same, but they have different variances. That means different levels of risk. Okay. So an investor will select the one, a rational investor would select the one having least variance. So on this basis, the whole edifice of the quantitative portfolio analysis is built. Thanks to Markowitz, a Nobel laureate, he proposed this framework. And even today, in most business schools, wherever finance is taught, there is a paper on portfolio analysis. And the foundation for this has been the Markowitz mean variance portfolio analysis. So in the mean variance for portfolio analysis, we should be a little alert in noting what is the assumption. The assumption is that we fix the expected rate of return. That means all those investors in the market have identical expectations with regard to the future returns, and they are taken for granted. Okay. Not only they are the same, they are taken for granted. Then an investor would choose that portfolio or those assets having least risk. So that means when there are two unknowns, one is expected return and the other unknown is the risk as captured by the variance. There is only one equation, but there are two unknowns, to speak the technical language. So therefore, one is assumed to be known or one is assumed to be constant or the same. Given that, how to minimize risk? That is the question. So here, what is the restrictive assumption in traditional finance? The restrictive assumption is the assumption that all investors accept the mean return at some pre-assigned level. We have investors of various kinds: risk averters, risk neutral, and risk loving. Okay, and each investor is also, emotionally bound by certain influences, to which we will come to that later. At this point of time, what we have to note is that all the investors in the market are assumed to be expecting the same level of return. What is open to them? What is open to them is only to minimize the risk. Okay, so it is in this context, the notion of how an individual views an investment decision is linked to the utility functions. All the investments, suppose a portfolio of investment, okay, it is expected to yield a given level of expected wealth in future. So therefore, to maximize the future wealth or expected level of wealth, okay, what is the tool that is used is the traditional utility function, okay? And the utility functions again are constructed based on several restrictive assumptions. One restrictive assumption is form of the function. It could be a linear function, it could be an exponential function, or a log linear function, or a translog function, whatever it is. So what all we get as the outcome of future wealth is conditional upon the type of utility function that we assume. Another strong restriction on utility function that is imposed is that they are assumed to be homothetic and separable. These are slightly technical concepts. I'm not going into those details. It may be enough to know that the utility function as a tool is subject to certain restrictions which are somewhat unrealistic. We are not allowing the data to choose its own form, but we try to arbitrarily impose it on that. Okay. So next is the CAPM model. CAPM model must be familiar to most students of economics, all students of commerce, and also all students of management. Since all of you are faculty, I presume that you must be familiar with the CAPM model, that is Capital Asset Pricing Model. What is the purpose of this model? This model tells us what should be the appropriate price of a capital asset. Okay, capital asset, right? So the formulation is that the excess expected return over and above a risk-free return is directly proportional to the market expected return. So here there are three components. If you analyze the CAPM equation, one is expected return. Then you have the risk-free return. And third one is the market return, that is the portfolio return. Okay. So that means you are linking the excess return of a particular asset to the market return. Okay. So if this is to be true, if this relation tells you something about the price of a capital asset, an important assumption that is made here is that the market portfolio is efficient. Only then the CAPM result holds good. So here what is the problem? Here also in CAPM, this is based on identical expectations. All investors have similar expectations. This is somewhat unseen when you write the beautiful expression of CAPM model. The underlying assumption is hardly noted. But now we note that the underlying assumption is highly restrictive. That is identical expectations. It is also assumed that all the investors are rational. We will come to that rationality a bit later. So with the introduction of CAPM, the focus has shifted from the variability of the asset, the variance of the assets, to another parameter known as the beta of an asset, which is treated as a measure of risk of the asset. Okay, so that is fine. We are replacing beta, we are replacing sigma, which is the standard deviation of the returns of the asset, by beta. That is fine. But what is restrictive here is that the model is based on identical expectations. It is a crucial assumption, but for our purpose, that is also highly restrictive assumption. Okay. So coming to the arbitrage models, okay, The arbitrage models are based on making the portfolio framework more simplified and more workable. So this is where we extract factors and build arbitrage models. Further, when we turn to the derivative assets, a similar question arises. What should be the appropriate price of a derivative asset? We have the famous, celebrated Black-Scholes formula. The Black-Scholes formula is based on another restrictive notion known as the risk-neutral probabilities. Okay, so like that, if we go on identifying the assumptions that are associated with the traditional finance, the list is very long. But now, for our purpose, we try to summarize and see how the behavioral finance as a discipline, as an young discipline which is growing, relaxes these assumptions and how more realistic elements are introduced into understanding the finance theory. Okay, so now we turn to that, right? The mainstream traditional finance assumes that people are rational actors. Okay, one assumption, assumption number one. Then assumption number two, they are free from emotions or effects of culture and social relations. We assume that the investors or individuals are free from emotions. They are neutral to the cultural framework and also social relations. Third assumption is that they are self-interested utility maximizers. Like mechanically, everyone would always be computing what is the gain, what is the loss, and thereby optimizing the utility or maximizing the utility. Okay? As far as individuals are concerned, these are the crucial assumptions that the mainstream finance has made. Further, when it comes to market, the assumption is that they are efficient. When do we say that the markets are efficient? Here the efficiency has to be understood in the sense of informational efficiency. And therefore, market is efficient in the way that the available information, which is available to all the market participants equally without any restriction, okay? They utilize this information fully. And by utilizing this information, they forecast what the future return or price is going to be. In that case, it is unlikely that different investors will have different expectations of the future price. So that means each market participant utilizes the information, that is, process the information according to a particular model, according to a particular formula. And what is the outcome? The outcome is that the expected outcomes are identical. That means in an efficient market, no investor will ever be able to beat the market. They will not be able to exploit the market, no matter how well informed is the investor. So such a situation we characterize as the efficient market. So efficiency, market efficiency and rationality are very much linked. If investors are rational, their activities are such that the market would tend to be informationally efficient. So in this context, we make an assumption that the firms are rational, profit maximizing entities. Okay. As we can see that the assumptions concerning individual investor, the assumptions concerning the market, the assumptions concerning the firms, all are based on some kind of strong restrictions. The assumptions are very strong. A theory is good if it is based on weaker assumptions, not stronger or restrictive assumptions. Okay. So to simplify this, the mainstream or traditional finance, okay, believes or assumes the following: both markets and investors are perfectly rational. Investors truly care about utilitarian characteristics. Investors have perfect self-control. They are not confused by cognitive errors. So to retranslate the mainstream or traditional finance beliefs or assumptions, what I just mentioned are the crucial points. Okay. So investors are rational and markets are efficient, to simplify matters further. Okay. But the behavioral finance challenges these assumptions. That is where we may say that the behavioral finance is a revolution in the field of finance. Since the mainstream has a very strong hold, okay, the growth of this rebellion discipline is somewhat slow. It has not been able to attract a large numbers to work on it because the mainstream is very strong in terms of its influence. But nevertheless, let us understand what those assumptions that the behavioral finance is made. One is investors are treated as normal, not rational. There's a difference in being normal and being rational. Now, they have limits to their self-control. Then investors are influenced by their own biases, cognitive biases. Investors make cognitive errors that may lead to wrong decisions. Okay, so these are the assumptions on which the behavioral finance is based. So therefore, behavioral finance is nothing but the traditional finance in which the human behavior is incorporated, to tell in simple terms. Then what is this discipline consisting of? It has three elements. One is sociology, three disciplines rather, sociology, psychology, and finance. Okay. So the three components, the three disciplines that contribute to behavioral finance are these: sociology, psychology, and finance. So from the discipline of sociology, okay, behavioral finance borrows how human social behavior and groups, how human social behavior and social groups, how they influence individual decision making. So this is drawn from the discipline of sociology. Second, from psychology, okay, it borrows how human behavior is to be studied and how the mental process, the cognitive process of an investor might take place. So from psychology, this is borrowed. And in finance, all the three are amalgamated because finance is a context in which the social and psychological behaviors are incorporated. So that enriches the behavioral finance. So the behavioral finance could be at two levels, one micro, the other macro. In micro level, the biases of individual investors are analyzed. And at the macro level, what are the market anomalies? What are the market anomalies? At the macro level, behavioral finance seeks to address these two. Okay. Now, what is at the back of this? There are two broad strands of theories. There are human behavioral theories. One theory is the prospect theory, which is developed by Kahneman in 1979. He was a Nobel laureate. In fact, he has given a great fillip to this discipline, that is behavioral finance. So he proposed the prospect theory. The second one is heuristic theory. Okay, let us very broadly capture the essence of these two. So in prospect theory, there are two phases in the choice of the process. That is, before taking a decision, the process undergoes two phases. In the early phase, they basically frame, that is what kind of portfolio one may have to prefer, etc. So a basic structure, basic ideas are put together in the first place. And in the second phase of the process, evaluation takes place. Okay. So how people manage risk and uncertainty. In the second phase, while evaluating, the risk and uncertainty would be taken into account. So thus, the prospect theory examines the apparent irregularities in human behavior when assessing risk under uncertainty. So people place more weightage on the outcomes that are perceived more certain than that are considered problematic. So it is here, though the traditional finance also tells the same thing, in behavioral finance, what is done over and above that is introducing human behavior into this. Okay? So how this is introduced in a phased manner? First, have a kind of a preliminary framing of the portfolios or whatever. And second, evaluating how risky is this. Of course, one may ask, this is the same thing which is done in the traditional finance theory as well. But the difference is that here the human element is incorporated. How this is done, perhaps when we talk about the research areas, we may have some quick look on that. The second theory is heuristic. Okay? In traditional finance, we assume that individuals are rational. They process the information in a very rational way. Okay? A complex situation is understood by making n number of calculations. But in heuristic theory of behavioral finance adopts rule of thumb, that is, how people make decisions, how they reach judgments and solve problems. Instead of getting into a wide range of calculations, people adopt certain rules of thumb that, for instance, the return of this asset after 2 months may not be more than this. Or the asset in which you are considering, maybe next month, it may not do well. Some kind of judgment, some kind of assessment. And how this assessment is done? By rule of thumb, based on judgment. And that is how they solve the problems. So that is, in the heuristic theory, complex problems are solved through simple solutions. So this is one approach to the behavioral two broad theories. Okay. So now we talk about the building blocks. What are the building blocks? Of course, what we discussed so far, when you put together, they form building blocks. But now we are trying to knit them together, all the pieces. So in behavioral finance, there are 4 basic components. 1, heuristic simplification. So that is, it is judgmental. Okay. So the information processing errors, which are human, are incorporated into this. Second thing is emotions, making decisions based on current emotional state of the individual. So one is heuristic simplification, which may involve some kind of processing errors. Second thing is emotion. Both seem very natural, you know. Third building block is social influence. After all, you know, human being is a social animal. If 10 people go in one direction, the 11th fellow also may move in the direction, some kind of herd behavior. So this is due to the social influence. Sometimes individuals also make decisions under what may be known as the self-deception. How does it occur? It occurs in the following way. There is a limit to the way we learn when we mistakenly think that we know more than what we actually do. We overestimate ourselves that we know everything about the market. But what we actually know is not sufficient enough to make informed decisions. This usually happens under self-deception. That is some kind of overconfidence. So self-deception, heuristic simplification, social influence, and emotions. So these are the building blocks of the behavioral finance. Okay. Now we go into some kind of biases. Okay. So there are so many biases that behavioral finance could reflect upon. We only mention a few. One is overconfidence and illusion of control, self-attribution bias, insight bias, confirmation bias, the narrative fallacy, representative bias, framing bias, anchoring bias, loss aversion, herding mentality, gambler's fallacy. Okay. So other biases could also be added to this list. One is black swan conjunction fallacy, scope neglect, bystander apathy, mental optimism, disposition effect, status quo, etc. Okay. So some of these things we briefly touch upon. One is in behavioral finance, a few concepts are there. Those concepts are mental accounting, that is propensity for people to allocate money for specific purposes. So once this mental accounting is made, it may interfere with the notion of rational decision making or rational investment, because mentally they are prepared to allocate money for certain specific purposes. Okay. Now, second one is herd behavior. That is, people tend to mimic the financial behavior of majority of the people, majority of the herd. Best example is stock market. Okay. Occasionally we say dramatic rallies and also dramatic sell-offs of certain stocks. Okay. If someone starts, if a small group of people, if they start selling off, then through herd behavior, the whole thing will be crumbled. That stock would come to really a halt. So this is referred to as the herd behavior. But herd behavior, which explains market anomalies more successfully, doesn't find place in the traditional finance. An emotional gap. Decision making based on extreme emotions or emotional strains such as anxiety, anger, fear, or excitement. Okay. Sometimes people make decisions when they are under emotional gap, or you may say emotional trap. Next is anchoring. Okay. Attaching a spending level to a reference. That means spending consistently based on budget level, rationalizing spending based on different satisfaction utilities. So that means we pre-assign that the spending should be with reference to a particular level. That is anchoring. Someone told you that, Infosys stock should do very well, so therefore you should invest it. So that involves some kind of anchoring bias. Okay? So like that, there are quite a few biases in some more biases we briefly touch upon. That is endowment effect, sunk cost fallacy, that is investment more money in a project because of previous investment. That is familiarity bias, and status quo bias, preference for current state of affairs. Also bandwagon effect. Okay. So like that, in the literature on behavioral finance, if you scan through, we have umpteen number of biases that have come to the surface. Some are within the realm of the social biases, that is social taboos, influence of social groups, and social influences. Others are cognitive biases based on the limitations of the human mind. Okay. So some more biases we briefly touch upon. Self-attribution. This bias involves a tendency to make choices based on overconfidence in one's own knowledge or skill. Okay. So how does this happen? It emanates from an intrinsic knack in a particular area. Suppose someone has familiarity in a particular area. So he or she may be tempted to get into that. Individuals tend to rank their knowledge higher than others, even though objectively it is not. So that means one may take decisions if there is what is known as a self-attribution bias, always feeling overconfident that their knowledge about, for instance, a stock is very good, and therefore they tend to lean in favor of that. Whereas objectively, the information base, the knowledge base that investors may have is falling short of the actual situation. So a bias that may creep in is due to the self-attribution. Then there are also biases which are heuristic biases and cognitive biases. Okay. A few of them are confirmation bias. Investors have a bias accepting information that confirms their already held beliefs in an investment. Already they have some pre-assigned beliefs. Okay. So they tend to make investment maybe in a stock to confirm their bias, because already they have a bias accepting certain information and it is continued. So this involves confirmation bias. Then experiential bias or recurring bias or availability bias, it is also known as. Investors' memory of recent events makes them biased. Suppose if you have more information about, let us say, certain stocks or about a market, okay, then the tendency is that such knowledge leads them to believe that the event is more likely to occur again. Suppose recently certain thing has happened. So before you go for investment, that dominates you. That dominates you, both negatively as well as positively. For example, the financial crisis of 2007, 2008, which is known as the meltdown period. All of you know what has happened in the meltdown period. What happened? Okay. The asset prices started falling on a very rapid pace. That is because the event was fresh in mind and it had a spread effect, and very soon the markets have crashed. Then this all happened because of the bias. Okay. The bias that such a situation may prolong, may continue into future, and therefore everybody would rush up towards selling off what they have. Then loss aversion. Some people, they may not like to take the risk. They always have aversion to the loss. Some investors, they're averse to losses. So when does it occur? When investors place greater weightage on the concern for losses than the pleasure from gaining from the market. Okay, so this is a very strange bias where they always place emphasis. Suppose if we invest in this stock, we may lose more. So therefore, let us not do that. But the same stock may give you handsome returns later. So if someone is overpowered by loss aversion, okay, the future prospective gains from the market are undermined because of this sentiment that they attach more weightage to the losses. Hence, concern for losses overrides the gains, market gains in future. So therefore, investors are more likely to try to assign a higher priority to avoiding losses than making proper investment gains. Then what happens? Some investors want a higher payout to compensate for the losses. Okay. So what they do in that case, if the high payout is not likely, then they may try to avoid losses altogether, even if the investment risk is acceptable from a rational standpoint of view. Let me explain this. For example, if a stock is perceived to be risky, okay, but they want to avoid the risk, and hence they shy away from that, okay? But actually the stock may be, from a rational standpoint of view, it is worthy of being considered for investment. So therefore the bias that is built into an investor is prone to such a bias. So the loss aversion bias may prevent someone from taking, at least trying to explore the possibilities of better investments. So another effect or bias is the disposition effect bias. That is, investors sell their winners and hang on to the losers. That is because of an effect known as the disposition effect. It occurs in the following way. So to recover entry price, suppose someone has purchased at a slightly higher price, but the stock may be a losing stock. So to recover entry price, what they do is they hang on to that asset, which is a losing asset. So they want to recover the entry price, ignoring the information or the attributes of the investment that they may have changed. The stock on which they are hanging on, that is, they would dispose it off only when they recover the entry price. With that, they hang on. While hanging on, they disregard the information characteristics of the asset. That is, the market for that asset may have changed, but this is not registered in the mind of the investor. This is because of the disposition effect. That is, they hang on to the losing stock because they want to recover the entry price. Okay? Then familiarity bias. Investors tend to invest in what they know. For instance, the familiarity to invest in domestic companies or locally owned investments, because the investor may have more familiarity with that. As a result, they won't diversify across multiple sectors or types of investments where the risk could be minimum. This is all because of familiarity bias. So like that, if we go on listing the biases, there are several. But typically, the biases that we have just now mentioned, there are only a few. We cannot discuss all the biases. They seem quite realistic that an investor is susceptible to these biases, either emanating from the social factors or the cognitive psychological factors. It is possible that typically an investor is liable to these biases. So in that case, what will happen to market? How to examine whether an investment is feasible or not? How to know the effect of these biases on the market, on individual returns, etc. So to examine these issues under the behavioral finance framework, okay, each of these biases or a group of biases, how they influence market, that becomes an important issue, an important research theme in behavioral finance. So over the years, starting from 1970s, okay, several people tried to explain the market from a behavioral finance perspective. Okay. So they introduced certain behavioral finance theories, and researchers concurrently or sequentially, they try to verify whether those theories are empirically valid or not. Some of them we will just touch upon. One is building models based on bounded rationality. Okay. Herbert Simon in 1955, he proposed this concept, not keeping in mind behavioral finance, but in economics, a new concept those days came into literature, because rationality assumption is realistic. So therefore, as an approximation to that, models of bounded rationality, because each rational investor or a firm has certain bounds. So what are those bounds within which he has to operate in a rational manner? So those models are referred to as models of bounded rationality. Okay. Then second, I'm not telling them in order of preference. I'm just listing them. Okay. Theory of cognitive dissonance. Third one, heuristic biases, availability, representativeness, anchoring, and adjustment. So here a group of biases have been set, and then they were theorized. How heuristic biases, availability, representatives, how they affect the markets, and how individuals subject to these biases, how he would behave in a market. Then next is the prospect theory, as I just briefly mentioned, which was introduced by Kahneman in 1979. He was awarded Nobel Prize for this. And he introduced loss aversion bias. He theorized how loss aversion takes place and how such a loss aversion would lead to individual investors missing opportunities. Then again, Kahneman and Tversky, they proposed framing bias. Like that, there are several people who worked on proposing behavioral finance theories, each theory based on an individual bias or a group of related biases. The mental accounting bias, theory of overreaction on stock markets. Typically, the meltdown was a situation of overreaction. Then investor sentiment bias. Okay? Sometimes market sentiment plays an important role. So what is the role of investor sentiment, okay, in underaction or overreaction? How sentiment plays an important role in the market, let us say stock market. Okay? So this leads to a theory known as investor sentiment theory that theorized how investment sentiment leads to underreaction or overreaction. What are the circumstances? So for that, models have been built. They are referred to as investor sentiment market models. In the case of stock market, 1998, Berberis, Sleffer, and Vishny, they examined this issue. Then we have arbitrage pricing theory models in our mainstream finance. So they have been modified to incorporate behavioral dimensions. And what was proposed is behavioral APT and behavioral portfolio theory. This is an alternative to the traditional portfolio theory. Okay, 1999, Meyer Statman has proposed this. Similarly, the linkages of behavioral finance with efficient market hypothesis to find that stock markets are inefficient. There is plenty of literature for your information to disprove efficient market hypothesis as much as in support of efficient market hypothesis. But there is a difference. Using the tools of mainstream traditional finance, you may generate empirical evidence both for as well as against the efficient market hypothesis. But that is not the same as examining how inefficient are the markets within the framework of behavioral finance. Actually, this important difference you should make. In the traditional or modern finance theory, we can prove or disprove whether a market is efficient or not. But what is realistic here is linking that to the behavioral finance concepts by introducing explicitly certain human biases. Then also there were attempts to incorporate prospect theory and link it to asset prices. Okay. Then behavioral factors in determining the trading behavior. Then effect of behavioral biases on stock prices. The price reversal for biased investors is quicker than unbiased investors. This is actually the central focus of that. That is, people reverse. If investors are biased, then price reversal is quicker than in the case of unbiased. So from this, we gather that the behavioral finance provides lucrative research opportunities for researchers either to working in the mainstream finance areas. Okay. To capture, to summarize, behavioral finance on investors, overconfidence and anchoring biases on investment decisions, then demographic factors and risk preferences on investor behavior. For example, younger people, what is their risk preference profile compared to the older ones? Then influence of psychological factors on investment behavior of, let us say, salaried persons, etc. Okay. I think we are running short of time, and if you permit, I will stop here. And a few questions or comments I would like to take. You can ask me directly.
Thank you very much, sir.
Welcome.
It is a good introduction to behavioral finance, and some of our participants, I think they have not enrolled for PhD, very few of them, but most of them already they are doctorates, and certainly they could be motivated from your lecture to pursue their postdoctoral research. And there are some supervisors also. Some of our participants, they are from the university system, and they're also supervisors. So certainly it is a good area for research. Thank you very much, sir, for sharing your expertise. And I didn't see any queries or any questions in the chat box, but we have one, my colleague, Professor Bhartendu Singh. This is also his area of interest, personal financial management and behavioral finance. This is also his area of interest. Professor Bhartendu, if you want to interact with the professor, it's up to you.
Yes, sir. Yes, sir. Thank you. Thanks for giving me the opportunity, sir. Actually, this is my interest area. I'm reading some things on this line, and I just got one reference to a paper, Behavioral Portfolio Theory. But I couldn't note the name of author. You told one model is developed for behavioral portfolio theory. I think Saffron or something S, started with something S.
Yeah. One moment. Yeah. See, this is by Meyer Statman.
Statman. Okay. Statman.
Yeah, Statman. Yeah.
Okay. So I will certainly download that paper and try to read. It looks very interesting. Sir, one thing always remain in my mind since our student time. Whenever we used to study economic theory, one line always used to come that if other things remains unchanged, and we used to discuss how come other things remains unchanged. Now this behavioral science, behavioral theory actually is going to take up those kind of things. It assumes other things also changes. That is actually a very good thing, and that actually encouraged my interest in this area. But the problem is when we talk about traditional finance, things are very much objective way. Formula is there, proper calculation is there. If we talk about risk, quantification of risk is there, how to calculate beta, how to calculate alpha, these things are there. But when we go to behavioral aspect, things are, I don't think it is that much quantifiable things. Like when we talk about this mental accounting. So it's okay, mental accounting, but how to quantify this mental accounting? How much? I understand what is this mental accounting. We should not create some accounts for a particular kind of thing. Like instead of keeping some savings in PPF account or some other place and taking loan for purchasing a car. That is because of mental accounting. But how to overcome these kind of things? How to remove these things?
Yeah.
Sir, before responding to this is a query, and there are a few more queries from the participants. How to improve the behavioral financial capacity? How to improve the behavioral financial capacity of marginalized laborers? Something like that. One question. Another question is, what is emotional gap in behavioral finance? Then there is another query. Behavioral finance is less about finance and more about psychology. Yes. This is a general perception. What is your take on it, sir?
Yeah, sure.
So please respond, sir.
Yeah, the first query. It is true that in economics or even in traditional finance, the assumption which we familiarly phrase it as ceteris paribus. So the behavioral finance or behavioral economics is not exactly proposed to overcome that ceteris paribus assumption. In the traditional behavioral economics in the traditional economics itself, there is general equilibrium theory. Okay, a well-articulated, a detailed, a disaggregated kind of theorizing is available in general equilibrium theory, in contrast to the ceteris paribus partial equilibrium theory. But when we talk about behavioral finance, the idea is not exactly to take into the other things. While it is important, that's not the main focus. The main focus is to incorporate the behavioral element, which emanates from the social behavior as well as from the cognitive behavior, okay, which takes care of the things which were hitherto held constant. So that difference has to be noted. I hope this observation may clarify the first query.
Okay.
Second thing, how the marginalized communities, if they have some surplus for investment, how do they cope up with all these calculations, etc.?
Even so-called educated people also difficult to understand.
Yes.
Okay.
So it is here, as I mentioned, the heuristic theory underlying the behavioral finance, which is more judgmental, which is based on the thumb rule. Okay, sometimes it may prove to be a better decision compared to the decisions based on so-called, information processing according to some formula or the other. So I think the judgmental thing, observing the market, forming some judgments, and going by the rule of thumb would simplify the complexity in the market. And people from the marginalized communities, I'm not assuming that they are ignorant or anything like that. Sometimes they may make more informed decisions. So that is my view on the second query. About the third one, how to measure these biases? It's a very important question. For that, we should go into the methodological details. See, psychologists, have devised certain measurements based on 10-point scale or 5-point scale, depending on the intensity of desire or intensity of a particular phenomenon. So the psychometricians have devised various measures, various scales, and behavioral finance researchers primarily use those measures in finance context. Like, do you agree or disagree or strongly agree or strongly disagree that a particular stock is risky? So to capture the investment sentiment, the psychometric scales as well as measures have been invariably employed. And for this purpose, more than the secondary data, primary data is used. Primary surveys are conducted. Primary cross-sectional investor surveys are conducted. We examine the influence of one or the other bias on the market. I think this is what I would like to share for the third query.
Thank you, sir. Thank you so much. And from the comments, I could understand our participants are immensely benefited with your talk. And thank you so much for accepting our invitation, sir. We are grateful to you, our university.
Thank you very much, sir. It's an opportunity for me. I feel privileged to talk to a cross-section of participants.
Yes.
That are gathered over there. for the refresher course. Thank you very much.
Thanks, sir. Namaste.
Namaste.
Now we have Professor Sunaina. She already joined.
Okay.
Sorry, if you are interested, you can be here, sir. No problem. Kamaiah garu.
Yeah, no problem. I would be happy to talk to you.
Yeah, because next speaker is also from Delhi University, and